Allison says, should there be a ratio or upward limit on the number of audits conducted versus number of employees a firm has? This feels loosely like 19th century factory work in some regard. I mean, that's what the entire business model was built on. Arthur Andersen created the pyramid structure of accounting firms and likened it to a factory, believe it or not, and went around and taught all the other accountants how to do it. And that made a lot of sense when work was very rote and manual, which it still is in many Big Four audit teams. You know, they've got Excel now, but they're still doing all the work by hand in Excel, really, in a lot of ways, right? So, I mean, you could try to do that. The only problem is if you try to set a limit, technology is going to change all that, right? It reduces the number of employees you need. But I still don't think it gets rid of the incentive to look the other way. That's the problem. That's the real problem, is that the auditors do not have a financial incentive to find fraud, to find significant issues. They have every incentive to get the audit done and look the other direction. And the only thing keeping them from doing that is ethics. But we know that when you put ethics up against money, money wins in business. So you have to create a system where you financially incentivize ethical behavior. And that would mean having somebody else hire the auditors and incentivizing the auditors to find problems. And you might say, oh, well, it's the investors who hire the auditors because it's the board of directors and the audit committee that does it. But a lot of times these audit committees and these boards of directors, they are so invested in the success of the business, they don't want to find issues either. Right? So, like, I think the real problem is it's not necessarily the reporting to the audit committee. It's just that the auditors have so much work, they need to get it done, they don't want to find problems. And so they avoid it, and they cut corners.